Good morning and welcome to our webinar today. We're delighted to have Melanie Hertz with us, who is with Thrivent Financial, and she is going to go over today the Care Forward product, which is a true hybrid product, and it's one that I'm excited about to add to our portfolio. They came out with it back in the summer, but we have not seen a lot of traction yet, but that's partly why we're doing this webinar today. So Melanie is going to teach us a thing about it. So Melanie, please take it over from here.
Awesome. Good morning, everyone. Thank you very much for being with us today. This is a real exciting solution to take a look at. This Care Forward product was designed to stand alongside of our traditional LTC solution, just to kind of try to give us an opportunity to serve more clients, having multiple extended care solutions backed by that strength and stability of the country's largest fraternal. So we're gonna dive in. Of course, I do real fastly here need to do the disclaimer. Remember that this presentation is intended only to educate you. It's broad in scope for training purposes and does not consider your client's individual personal financial situation. Your client's personal financial situation is unique, and the information and advice may not be suitable for all situations. So, yesterday we talked about our fraternal story. We are the world's largest fraternal, not a stock company. As a fraternal, we are a not-for-profit, tax-exempt organization where our members share a common bond. At the end of today's presentation, we will go through that common bond requirement a little bit more in depth to just kind of help you have a little bit better understanding on how to position Thrivent as an option. We have that A++ rating with AM Best. It's hard to beat. You know, named the world's most ethical companies by Ethisphere Institute for 10 years in a row. Our Comdex comes up often. It juggles between a 99 and 100. Last year it was at 100 and is at 100 right now. But just the strength of who we are is certainly a stand apart, even from some of the others in this space. All are good, of course, that are leading this industry. When we built this Care Forward product, I think what you'll find is that we borrowed from the best of all the best in the industry and made Care Forward just to open up to more options, like you'd expect a hybrid solution to be. Our solution is a permanent whole life insurance solution with tremendous flexibility. You think about the dual features. So it's going to pay for your long-term care expenses, and there's a death benefit there if you don't use it or you only use it for a short period of time. We'd know with all of these hybrid solutions, the death benefit is the first thing to go. And on most structures, for other solutions, that base death benefit is going to be exhausted in a 2 to 3 year period. That's pretty much the truth with ours as well. We made ours just a little bit more flexible there. The complexity of it is really where what makes it happen. So we have the dual features. Remember that when it comes to care preferences, the solution itself is not here to dictate how your client wants to receive their care. It's a comprehensive solution, gonna cover you in whichever environment. It's there to pay for the care. It is a reimbursement model. You have the premium guarantee with this solution, which the roller coaster of the economy, having stability in a solution like this is a real value. It has a cash value on it. You can absolutely quit the policy and cash out, right? That gives me, I'm being transparent here, that gives me a little bit of a pit in my gut. The thing is, uh, it it's it's crazy how it comes up because consumers today are worried about that emergency fund. Well, we definitely do not want to cash out because it throws out the long-term care solution that we work so hard to put in place. On the other hand, it's there. So if push comes to shove, that's how these linked benefit solutions work. The other thing we did on our solution is we zapped that elimination period down to a 0 day for home health care and adult daycare. It's a standard 90-day elim for facility care, and you can't change the elimination period on this care forward solution. Um, we're gonna fly through this slide, and talk about the moving parts, and then go into a couple of case studies. I want to show you the actual hands-on software as we look at this first case study in a bit, and you can see what options are adjustable and give you the flexibility, and what are not. So with Thrivent, we started out as two separate fraternals, Aid Association for Lutherans and Lutheran Brotherhood. Now, those two Aid associations was actually formed in 1902. Lutheran Brotherhood began in 1917. They stood up their first long-term care solutions in 1987. um, as Thrivent had these solutions available up until 2001 when these two fraternals merged. When that merger happened and Thrivent was born, we became the world's largest fraternal organization. It took a bit after the merger to get our own long-term care solution on the shelf. That traditional solution came aboard in 2012. The current product is available, which was priced in 2016. And then last summer, we launched our Care Forward solution. This is the first whole life solution with a long-term care rider on it. As far as our differentiators, the issue ages is a biggie. We are the linked benefits solution that does dip down to age 18, almost as high of issue age cap as the traditional. On this one, we'll go up to age 75. Still as low as 1,500 a month, all the way up to 15,000. When you're thinking about that robust long-term care plan, that can often be one of the most important components to figure out. How much is this policy going to pay me or pay us? Um, how much do we have to work with every month? 1,500 to 15,000. Our duration is what gets most people confused. The duration can go as low as 20 months all the way up to 100 months. And we're going to spend a lot of time on that. How you get to the duration, this 20 months to 100 months, you're going to take into account how quickly you are accelerating the death benefit, and then how much leverage do you want on the death benefit? Do you only want to accelerate the death benefit by 1 times, or do you want to put an extension rider on there, which is going to be most favorable at either 2 times the death benefit or 3 times the death benefit. I'll show you a chart in just a little bit. We talked about the elimination period. Oops, I skipped past the inflation. You know, for a lot of folks, inflation is going to be key for making sure that these solutions are going to keep up with time and not be obsolete in 20, 30, 40 years. So with ours, you can do a 3% compound that caps in 20 years, or you can do a 3 or 5% compound that grows for the life of the contract. A big differentiator on our solution. I think about when hybrids were hot 20 years ago, almost everything came in on a single pay. Then we started seeing a little bit more flexibility with some of the solutions going up to a 10 pay, and now it's evolved to where you can go a 20 pay or a pay to 95. With our solution, um, one thing that is very valuable, definitely do not underplay this. If you're going with like a 20 pay, or maybe a little bit more specifically, a pay to 95, on our solution, when you trigger the claim for long-term care, your total premium is waived. And I'll show you that in the software in just a second. But basically, what that means is that you're not paying for the benefit portion to maintain the death benefit while you're on claim. If you go back off a claim and have exhausted your death benefit and still have some long-term care benefit left, you're only paying for the long-term care portion of the premium. That's huge. All right. Let's just remember real quickly, this is a comprehensive solution. I want to take 1 second and just note our solution for Care Forward is available in all states except New York and California. It has been filed in California. It has not yet been approved in California. So you do want to be aware of where you can get it. And then, of course, how the solution works. Standard stuff here works identical to our traditional. If I'm going too fast, just stop me. This is, as I mentioned, a comprehensive solution. So it's just laying out for you the different settings as you're talking to your clients and they tell you that they're not going into the nursing home. Remind them this can easily be considered a nursing home avoidance solution by leveraging the benefits outside of the nursing home itself. It has standard features on this thing. We talked about the waiver of premium already. You've got the care coordination on this solution, um, plus bed reservation for up to 60 days. A lot of solutions will be at 30 per calendar year. We're at 60. The alternate plan of care is baked into this solution as well. You've got respite care, home modifications, in international care, caregiver training, all those benefits that make a long-term care solution meaningful, you're going to find in our Care Forward solution. This is the page that trips most folks up, and that's why we put this chart in here. So when you accelerate the death benefit by 5%, and take that death benefit by 3 times the multiplier, it's going to get you a 60-month duration. With our 60-month duration, 5-year duration, that's going to be a real popular fit. What I would tell you, I think, is really, really important is, I'm going to demo this for you in a minute. When you look at like a 3 to 5 year is kind of an ideal duration for a lot of solutions. So you might be thinking, well, a lot of reps will correlate this percentage payout as like an inflation guard. This is not an inflation guard. You can absolutely buy inflation. This is literally just um, how quickly you want to, or how robust you want to have your monthly benefit, and then also it affects the duration and total pool of money. Um, I'm gonna try to zip through this so I can actually show you hands-on. It'll make a lot more sense. And I want you to just know that if you need to spreadsheet it just to wrap your brain around it, that's how this thing came to be, because it took me a long time to understand how this works and really um, understand where those sweet spots were going to be. All right. Um, with our inflation guards, this is pretty standard stuff here. The rates are fixed. You're going to get either no inflation or any of these three options. And of course, um, the cost to include the increase is built into the premium. So it's going to be a level premium for the life of the policy. Um, let's see, as far as payment options, pretty important to understand. We can absolutely 1035 into this solution. You can do a single pay. You can do a dump in and pay the rest off over 10 years. And the only thing I would call out is on our pay to 95, the maximum issue age for a pay to 95 is going to be age 65. Just so you're aware, you can write a person all the way through age 75, but if you do that, it's going to have to be on a 20 pay, a 10 pay, or a single pay. All right. So, the couples discount, this is a little different on this solution compared to our traditional. You get a full spousal discount if you're part of a couple. It does not matter who applies with this solution. You might remember from yesterday's training when on our traditional, if one person takes the traditional and the other spouse takes the Care Forward solution, the person on traditional is automatically going to get that full spousal discount. With Care Forward, it actually doesn't make any difference. If you get if you're part of a couple, you're getting the full couples discount. All right, we are into our first case study. So in this case study, we have a 57-year-old female. Her name is Mary. She has some life insurance already. Her goals are, she likes the idea of guaranteed benefits and premiums. She likes the idea of a what if, flexibility to cash out, and she wants to ensure a legacy for her children and also protect herself from an expense associated with the possibility of extended care. So, what we're going to do is pull up the quoting software, and I'll make sure you guys have I'll make sure that you guys have a link to this. I have a Thrivent issued laptop, so mine looks just slightly different. See up in this URL where it says like SSO, that stands for single sign-on. Yours is gonna look just slightly different. Once you have a writing number, you can access this software and or have Marshall run it for you too, I guess. But the only way to get into this software is to, did I get that right? Yeah, I didn't. Go figure. The only way to, I did it again. The only way to get into this software is to have a writing number. I'm going to stop talking for 1 second because apparently today I cannot multitask. 65472. Okay. Now we're cooking. Okay, so this URL, partner.thrivent.com, this is the actual page that you'll go to. Like I said, I'll make sure you have this. To run a quote, you go to partner.com, you log in with your writing number and password, and you're going to go into the quotes and printable applications. Once you're in our quotes and printable applications, you'll click on Run Quote/illustration. This is going to launch a program we call Solution Studio. Now, about 2 weeks ago, we noticed a glitch. When you're going in here for the first time, you may have just a little bit of a hiccup on that very first quote that you run. If you run into issues, let us know. I ran it up the flagpole with our programmers, and I think it's fixed, but I don't have a way to actually test it because I can't really repeat it, you know. So I'm going to go into Care Forward, and I'll show you the side-by-side comparison in a second. But I just want to go into the standard software here for a second, and just show you a couple of things I really, really like. One thing to note, if the owner, this is a life insurance policy, so if the owner of the policy is different from the insured, you just want to make sure you are using the state code of the owner. We have 4 rate classes with this solution. It's non-tobacco, tobacco, and then a non-tobacco class 1 and a tobacco class 1. So verify this information with your client. And then, of course, if we have a couples discount, we'll put it in here. Just to make things go a little bit quicker today, I'm going to say no to that second person. And this is Mary. That's right. And what her goal was, she was looking for some guaranteed premiums. She wanted to cash out. I'm gonna start her out with a pay to 95, mainly for affordability. It's much easier as you're working through this with your client to have them tell you, hey, I think it'd be better to pay it off in 20 years or 10, or, well, I do have some money that I can roll in. Great. Um, yes, but I'm going to start off today with a pay to 95. And then you can specify how you want to grow this thing. See how it just defaults. It's got to put something in there. So it's going to default with a face amount of 100,000, which is really doesn't matter. If I want to build this based on a monthly maximum benefit of, let's just say 4,000 a month, and I can say today's age, or we decided that at age 80, she needs to have a $8,000 or $10,000 a month. I can back into a benefit that way. I can wipe this out and say age 80, and wham bam, I'm going to start getting a solution together. I don't really want to figure it on age 80. So I'm going to change this back to the 4,000 a month here quick. And then I'm looking at this multiplier. And it's going to default to 3 times the death benefit. So up here, you see you got a face amount of 80,000. Because I have a 3 times multiplier, it's going to start my long-term care pool out at 240,000. And my duration is 60 months. For that, I'm paying a premium of $3,200. I want to see a projected value let's go out to age 85. How about? So in this case, without an inflation guard on here, which I'm going to add in a second, you can see what her benefit is at, what the premium. She's paying $3,200 a year, and she's got 240,000. Not bad, but we can do better. Let's put an inflation guard on this. She's 57. I'm going to try a 3% compound for the life of the contract. So it's going to jump the premium to 54.64, which doesn't look too bad. The face amount is going to stay the same because I didn't mess with either of these two figures. The pool of money is going to stay the same starting out, but the premium is going to go up a little bit. Notice though that by adding 3% compound, you're taking that 240,000 pool, 4,000 a month, and it's well over double that benefit. And guess what? It you've got the death benefit there. You got a nice, robust long-term care benefit, and hey, that premium looks pretty good. But we can actually do even better depending on what your client wants. Let's just say your client says, this is good. How about something just a little bit more affordable? You could take this to a 3% compound for 20 years, and it's going to drop that premium to $47.02 annually. And you can see how you still have a $7,224 benefit. Or I could take this and make it a little bit smaller pool of money. I'm going to take it to a 2 times multiplier. Now I've got the 80,000 death benefit. Times 2 is gonna be 160,000. It's a 40 month. My premium dropped to $4,086. That first benefit that I showed you was at about 5,500. The difference between 4,086 and 5,500 could easily be the difference between yes and I need to think about it. So, just a thought of what to think about, how you want to structure this. If I take this percentage, I want to just show you what happens here because I'm solving for a monthly maximum benefit of 4,000 per month starting out. If I take this death benefit and I accelerate the death benefit by 4%, in effect, what you're going to get is a little higher death benefit. But you know what? This is a nice little package here. It's a little longer duration. The premium is still under 5,000 a year. And at the time of claim, it's still a decent pool of money that your client is going to have access to. Here, your cumulative premium is going to be a little bit closer to the death benefit. And most folks, when you're doing a pay to 95, most folks aren't overly worried about the death benefit and the premium being, they really honestly hardly ever look at that. But if you go to like a 10 pay, for example, you can see that it's going to affect the cash value, and the death benefit and the premium amount are going to be a little bit more in check. If I take this down to a 3%, the death benefit is just a hair higher. Hopefully I haven't completely confused you yet. I want to just show you one more thing before I go into that next case study. If I watch what happens here when I have the death benefit accelerated by 3%, and I take this to a different inflation guard. See how based on the inflation and the payment mode, um, based on the inflation and the payment mode, um, that is also going to help determine what these values are going to look like over time. Um, if for example, I did a 3% acceleration, 1 times multiplier, um, this is, and I'm going to pull the inflation for a second just to show you a really bad package. Um, if I basically all I'm buying here is a death benefit of 133,000. It'll pay out 4,000 a month for long-term care, and it'll pay out for a full 33 months, but I'm paying in 84,000 and I'm only getting back um, a monthly maximum benefit of 133,000. And of course, that is what my death benefit is. For most people, they see this leverage of not even 2 times, and they would run for the hills, as would I if I was a consumer. But notice as we bring that up back to like a 4%, and I pulled the inflation off, so these numbers are going to look a little bit different here. It continuously, as long as I'm on this 1 times multiplier, the rates are going to continuously be fairly outrageous. But as I go to a 5% acceleration, it gets a little bit more in check. It's just not the best leverage on your dollar. The reason the rates are cheaper is because we're not giving you much of anything to work with. You're paying in 51,000 to get an $80,000 death benefit and an $80,000 long-term care benefit. That's really poor leverage. You take this back up to a 2 times multiplier or a 3 times multiplier, and it's just a much better value. And on a 57-year-old, I'd go back and I'd be looking really hard at some the cost or putting some inflation on here. Let me go in real fast. I want to show you the output on this software. I want to call out that you can click on this cost of care survey and pick your state, and it's gonna, and then you can actually pick your city. Let's do Raleigh, I suppose. It's gonna show you the cost for in the different dynamics for a private room, a semi-private room, or of course, if you're doing home health care or assisted living, what those rates are gonna run. Let's go back in to the software. I want to show you the output options. What does this quote actually look like? You can include the cost of care study, the break-even analysis, the projection on a hypothetical claim. This does take a little bit to put in here. I'm going to use just max out the monthly benefit, and let's pretend that we're on claim for 2 years. I'm going to say give me some options, and then I also want to look at the underwriting process. I'm going to take the projections out to age 85. I can't even remember where we ended up with inflation on this thing, but let's take a look at what we have for this sample and show you what a real quote looks like. I'm not going to make you put on your readers today. This is the cover page of our Care Forward solution. Of course, we're going to highlight the strength of who we are. I'm going to zip down to the summary. This again is going to just be a track to run on, reminding your clients that this is a comprehensive solution. Here's what you're paying in for a premium. Here's your life insurance amount. Here's your long-term care amount starting out. And then here's where it's going to break down the costs. This is what you would have for a life insurance premium. If you're looking for a deduction in the long-term care premium, um, this is going to be your base, and then all in, it's going to be 69.46. As I gotta bring this down just a hair. There we go. As I look at how it works, it's just showing you here that it's going to start out at 240,000. At age 85, it's going to be a little about 550,000 roughly. That monthly benefit starts out at 4,000 and grows to $9,151. Um, and of course, just because of who we are, we want to make sure we're very consumer centric, paint that very clear picture that you've got the 549,000 available in long-term care benefits, but if you go on claim, it's your death benefit is going to be the first thing to go. Once your death benefit is gone, you're going to have the rest of this long-term care benefit. The reason that they were looking at this in the first place, of 469,000. In another hypothetical, let's say you've got a death benefit of 80,000 and you're on claim a couple of months. The balance is going to go to your beneficiary. It's a whole life policy, so it'll go to your beneficiary as a death benefit there as well. This is probably my favorite page of the entire quote. I love showing a client that, oh, I must have put it on a 20 pay, which is fine. You're paying in X amount of premium. Here's the sum of the premium that you're paying in. Your cash value is going to vary. The longer you have this thing in place, the cash value is going to vary. The other factor is, if you're doing like a single pay or something, your cash value, or even a 10 pay for that matter, your cash value is going to go higher. Think of it like it's paid off more quickly, so it's gonna pay out, or the cash value is going to be higher right out of the gate on those shorter pays. Because this is whole life, your death benefit is going to be a fixed amount, but here you go. Here's your long-term care benefit. It looks like we chose the 3% compound for the life of the contract. So it's showing you that pool, and it's showing you that long-term care benefit, how that's going to grow, which is really, really handy. It goes through age 121. Break-even analysis is, it's used, this doesn't come up as much as it does when you're showing a traditional case, but you can see claiming for a very, very, very short period of time. They're paying in the premiums, and they're gonna get their money back pretty quickly. With a hypothetical claim, I very quickly just toss some numbers in here. In this situation, what we're showing is that this client went on claim at age 85. At age 85, the person needed benefit, and it paid out, well, it would have paid out $9,152 per month. First, of course, the death benefit goes in year one. There's just a little bit of death benefit left over. In year two, there would be basically the rest of, if I'm accelerating by 5% on that death benefit's going to be gone in 20 months. So by the end of that second year, there's no more death benefit, but there's still plenty of long-term care benefit that is going to continue growing, but with inflation, but it's just minus claim. That's why this pool is getting smaller. If, for example, this client would have went off of claim, remember that they'd only be paying when they become healthy. Well, it's a 20 pay, sorry. If you were doing a pay to 95 and this person went off a claim, you would you would only be paying the LTC portion of the premium left. Um, this is probably, if you really truly want to wrap your brain around those moving parts, tell me once again, how does that acceleration work? And I've got the 3 times multiplier on here, obviously, but this is the percentage payout, the acceleration of that death benefit. Look at your premiums versus your benefits. You hopefully this will help you understand um how what the differentiator is when you're accelerating by 3% versus 4%. If I'm solving for a long-term care pool, that 5% acceleration versus a 3, look at the monthly benefit. This is what I would call a long skinny, or trying to build short fat with, for most folks. That's what helps define what a robust long-term care solution is going to be. Um, okay, let's see here. We've got our cost of care that pulls into the survey or into the quote itself, and it's sourced, of course, which is super helpful. And then it just tries to explain to you, if you do a 2 or 3 times multiplier on that death benefit, you're buying an extension rider. If you're looking at like a Money Guard or a Nationwide or Securian or, oh, what have you, um, that's like all done behind the scenes. You're just buying a 2-year or a 3-year, and then hopefully you're remembering that a 6-year is a sweet spot. With ours, um, we are a little bit more transparent, which can make it a little bit confusing. If you like a cookie cutter option, um, I would go back into that software, and I would go back into this software, and on probably almost every client, I would automatically start out with like a pay to 95 or a 10 pay, depending on what their goals are, right? And I'd start out with a monthly maximum benefit of XYZ, and I would look at a multiplier of either 2 or 3 times the death benefit, and I would almost always accelerate that death benefit by 4 or 5%. We set it up to default at 5, because for a lot of clients, that's going to be the best bang for their buck. I've done a ton of talking. I think I'm gonna go back into the presentation. Um, oh, I know what I wanted to do. I wanted to show you a case based on a budget. Just real quick, we got a few seconds. I'm gonna go back into my software here quick, and I want to do a new illustration. So let's look at my buddy Jamie. He was 38, if I'm not mistaken, and he wanted to do a budget. So I'm gonna say no to his couple's discount. I can't remember if he wanted to have it paid up or not. Yeah, he wanted to, well, he's only 38 years old. Duh. So of course, if he pays this thing off in 20 years, that's hypothetically before retirement. That should be a huge win for him. But he wanted to stay within a $250 a month premium. Can we get it done? Well, he also wanted to leverage a $10,000 CD. So how would I do that? So I've got his information in here. Male, Minnesota, 38 years old, non-tobacco, no couples discount. Because he's only 38, you can have this thing paid off in 20 years. That would be a huge win. Um, we can look at inflation in 1 second here, but I want to look at what it's going to do to throw in $10,000 in premium. I don't have a 1035 to add to it. I would like for a 38-year-old, can I put an inflation guard on it? I'm going to adjust this. Um, I'm going to adjust these projections. So without a inflation guard, as I have this thing defaulting to the 5% acceleration, 3 times multiplier, um, excuse me, it's gonna be a pretty decent monthly benefit of $6,033 or $333. Pretty awesome looking policy. At the time of claim, because I have no inflation on here, you still have a death benefit. You can still cash out. And you know, you've got that 6,300 and some odd dollars with a monthly budget of $250. Not bad. Let's see if we can do anything better. If, for example, I wanted to just wrap my brain around the 4% acceleration, what is that going to do when I'm figuring on a budget rather than on a benefit? If I accelerate this by 4%, do you think the monthly maximum benefit is going to go up or down? Well, your lines are muted, but the answer there, the answer to why the benefit would go, the monthly benefit is going to go down is because you're accelerating the death benefit by a lesser percentage. So when I accelerate this by a lesser percentage, it's going to be $5,242. I got a longer policy. I can take this to a 2 times multiplier and see how it doesn't really do much for me. It's a tougher sell as far as the leverage goes. I don't know if I can even get into a 3% with this budget. I can, but now look at what happened to my monthly maximum benefit. $4,000 a month at age 80 isn't looking too hot. I can take it to a 2 times multiplier. It goes up a hair, but it's still not the best structure. So while I'm messing with this, I want to answer a couple of questions. If you do a paid to 95, does the premium stop and the contract covers for a lifetime? Well, the contract will cover the premium. If you do a paid to 95, the premium is going to stop at age 95 and the contract is going to cover for whatever duration or whatever pool of money you grow. We don't have a lifetime benefit. The longest benefit that you can do is technically 100 months. So Bob, hopefully that answers your question. When you do a pay to 95, your premiums stop at age 95 or when you go on claim, and the policy is gonna be there for you until the benefit runs out, either at the point of death or well, at the point of death, or obviously if you exhaust the benefits through a claim. You can go on claim at whatever age bracket, 100, 110, or 52, whatever it happens to be.
That's great. Thank you.
Yes, yes, absolutely. Wayne had a question on why is there no residual death benefit? We designed this solution to not have a residual death benefit, because that residual death benefit, if they're needing it for long-term care, that residual death benefit with other solutions like Nationwide, for example, is 20%. That's a chunk. And while it, I guess, can be with Nationwide, for example, it can be used, you know, as a final expense, I guess. You know, when you think about Medicaid eligibility and pre-planning. Like a funeral expense is one of those things that can easily have funds set aside. So, you can do that pre-planning. Um, if you, if you're, we didn't feel like when you look at a nationwide solution, by having that 20% set aside for residual death benefit, what it's going to do is water down your benefits in every other place. So we made a decision to I mean, MoneyGuard it'll do 5%. But even at 5%, 5% of if you're building this like most people are, 5% of like 104,000 for for what it would cost to add even I mean, a 5% is fairly low. For what it's going to cost, would have cost us to add a small residual death benefit. It wasn't worth it. When you think about our solution, we're trying to be very prescriptive here in that we know that we want this to be the main purpose of this is to be the most robust long-term care solution out there. Not not We're not trying to be all things to all people, and um yes, there's a death benefit there if they don't use it, but it's kind of the afterthought, if you would. um how I would build this policy for Jamie. Look at what I just did for him. When I put an inflation guard on here for the life of the contract, it doesn't take a lot of salesmanship to get a person to see that this is one stellar looking solution. He's got this policy paid up in 20 years. His premium per month is $250. He starts out at um you know that death benefit of 57 thousand, and and excuse me, the long-term care is what I was trying to point out, of 211,000, 3,500 a month in long-term care benefit. But because of his age, he's got 710,000 available at that time of claim, paying out $11,836. He can still cash it out if he wants to. His death benefit is almost identical to the premium that he paid in. This is a really nice looking solution, and um, yeah, it just makes really good sense. If I was wanted just for curiosity's sake, I built this around this $250 here. But if I just for 1 second, I just flip this over to a monthly maximum benefit of, sure, let's do that same amount, um, and take it to a 10 pay though, just for your own curiosity. Look at what look at for a tiny bit more, um, you can get a lot better leverage. I would just say that, you know, um, not everybody can pay up in a short period of time. So that's why, bulk of our business is coming in on either a 20 pay or a pay to 95. But just look at this. I mean, for a 38-year-old, if he was doing a pay to 95, and I want to do this on a monthly basis because that's what I was doing before. Look at the cumulative premium that he's paid in for. I was budgeting around 250 a month. Here, look at all the extra years that he's paying in. His all in on a pay to 95 is 97,000 versus on a 20 pay, without even trying, by doing a little bit of pre-planning, look, you just saved them over $20,000. Uh, eh, wow. This is a nice policy. And, you know, if, I was showing you a premium, a little bit ago of, what am I doing here? I was showing you a premium a little bit ago of, uh, 200, what a $250 budget will buy you. The thing is, you can go down to whatever, right? Um, if the one thing that your 38-year-old has going for them is time, right? So it'll tell you based on this structure, you're going to have to adjust your benefits. If you want a $200 benefit on a 20 pay, you're going to have to do some trimming. And with that, I could say, well, show me a something that's going to cap in 20 years. Thing is, on this guy, a 38-year-old, we're going to have a gap here. Hang on. Oh goodness, I couldn't get to my mute button fast enough. Oh, sorry about that. Okay. I threw a lot at you today. I get that. I can't see your faces, so hopefully you haven't fallen asleep. I would tell you that hopefully this. Hopefully I've given you enough um oh, excuse me. Hopefully I have given you enough here to give you a little bit of insights on how this solution is is maybe a little bit different in a great way. How we have kept all the core things that your consumers are going to be needing in a meaningful long-term care solution, without you clearly have a lot more price points that you can get to without compromising the benefits. At the end of the day, it's more funding options, more age brackets, more payment options, and better sweet spots, specifically in that 5% acceleration, 2 to 3 times multiplier, and the 4% acceleration with the 2 times multiplier. There's just a lot that you can do with this solution that you just simply cannot do with the others and still get the leverage that you're looking for. Let's talk about the Christian attestation. As promised, we want to address that Christian requirement question. We know that Thrivent is a fraternal organization whose common bond is to serve Christians. The question on the application that your client attests to, I am a Christian seeking to live out my faith, or I am the spouse of a Christian who seeks to live out his or her faith. If you do not know what your client's faith is, because they are so um, private about their faith, perhaps use the positioning statement. We have a few different solutions that we can discuss. One that I'd like to present is with a fraternal benefits organization called Thrivent. They're a top-rated financial services organization that was formed to serve Christians. I don't know if that's an option for you, and if it's not, that's okay. We have a few other options that we can discuss. If you stop talking at that point, they will tell you, yeah, that's fine, let's take a look, or you know what, that's not for me. I just don't wait till the point of the application to verify that your client can qualify, meet the membership requirement. Without further ado, I see we have a quick question. Oh, yeah. Absolutely happy to chat with you guys today. And hopefully, this is just scratching the surface. Chat with Marshall, and of course, we will, as we need to do additional training, we certainly will. I want to thank you so much for being on the call today. It means a lot, and we hope this is just the beginning of a great relationship. Thank you all so much.
Thank you, Melanie. And I would just reiterate to everybody that I can help you. You know, it's interesting, Melanie, I've been using WinFlex to run illustrations, and it doesn't have that
Oh, yeah.
nearly the tools that you just showed. I'm going to, from now on, use those. But I have one quick question. You know, we talked yesterday about how Thrivent has some unique underwriting sweet spots, if you will, with the traditional plan. Is that how does it compare underwriting for Care Forward with the traditional product?
We've got the 4 rate classes, which is better than some of the others in the industry. You know, it's just a quick yeah or a quick no or a yes. So I mean, we will underwrite the solution. I would say that right out of the gate, our height and weight chart is not gonna be what it is for some. And part of that is probably because we're looking at the full picture. We'll take certain conditions, heart conditions are fairly common, cholesterol, some of the common things that people have. But their weight does need to be, somewhat in check. It's we're we have a pretty good height and weight chart. But it's if you're extremely underweight or extremely overweight, it's not going to be a solution for your client. So the process is fantastic. You've got accelerated underwriting for those 60 and under with Care Forward. But I would all in every case, I would verify the health conditions before I would be too deep in the weeds on looking at packages. So you know that you have the right rate class. That is super important. We do have the class 1. We have the tobacco class 1. Leverage that. And if you don't want to look at the underwriting guide, which I that's fine, I understand, then pre-qualify it so you know what our stability periods are on some of these conditions. Almost everybody is managing their health in some way or another. Give us that to work with before you take an app. And again, if you can quote those underage 60 and under, and they can get that accelerated underwriting, you're going to be very happy to have a case, issued in a very short period of time.
Very good. Well, again, thank you, Melanie. And for those, I see everybody's hung on through this. I know we're up at the hour. We're past the top of the hour. Thank you for your time. Just FYI, I will be sending you documents of helps, the product brochures. I know who's on this call, and I'll be sending you support information both on the traditional and the Care Forward hybrid plan. Of course, this recording, this presentation has been recorded, as was yesterday's. If you missed it, some of you did, I see. So that will be coming to you. A link to this recording will be coming to you as well. And I'm always here to help with questions. And Melanie, we'll have to get you down to North Carolina sometime. We can do this live. Next time you're in our neck of the woods, maybe we can coordinate that. And we'd love to have a live presentation in Greensboro and or Raleigh.
Perfect. Sounds wonderful.
And meanwhile, send us some of that snow, that 5 feet of snow in your backyard. Send us some of it. We need, for the snow lovers like me, we want some of that. Send it our way.
You know it. We'll make that happen.
All right.
All right. Thank you so
all.
much.
And we'll be talking, Melanie. Have a great day, everyone. Thanks for tuning in.
Yep. Goodbye.